Hello and welcome to Real Wealth. I'm Stacey Stegenga, one of the investment counselors here. Recently, we saw a dip in mortgage rates, so we wanted to bring in a lender, Caeli Ridge of Ridge Lending. She's going to break it all down: why rates have dropped, whether we can expect them to stay low, and most importantly, if now is a smart time to invest. Spoiler alert, it always is. Thanks so much for joining us today. This is Caeli with Ridge Lending. How are you?
I'm so good, Stacey. Thank you for having me. It's nice to be here with you this morning.
Yes, thank you so much for joining us. I am so excited to hear your thoughts and opinions on the rate drops. So last week, our 30-year fixed rate has decreased. Do you mind talking about how big the dip was and what is driving that?
So I want to first start by making sure everybody is aware that when we talk about the long-term mortgage bonds, and as they're published out there for consumers to absorb or to digest, it's very important that they understand that that's the baseline for owner-occupied transactions. Okay. So without getting too technical, there's something called an LLPA. Anyone that's been listening to me for any period of time has heard me talk about this: loan level price adjustment. Positive and negative numbers that associate with the transaction characteristics. Owner occupied, primary residence where you live, is going to have a lower LLPA adjustment when compared to a non-owner occupied or investment property transaction. Is going to have a higher LLPA. So generally speaking, this is general rule of thumb. Okay, there's lots of different variables, things like credit score, loan to value, loan size, single family versus 2 to 4 unit. All of these things have their own unique LLPA, but generally speaking, they should expect about a 1% difference between owner occupied and non-owner occupied. Okay, general. So going back to your question, I think that, there's a lot of data points that are going to dictate where interest rates go. And I'm sure that Kathy talked about this last week. But I think that the economy, in terms of the metrics that we look for, which are the PCE, personal consumption expenditure, the CPI, Consumer Price Index, and then finally last week's jobs report, I think all kind of led to that slight dip to where we were prior. It wasn't a huge barometer change from one to the other, but I agree there was a small improvement. Now, when we translate that over into the non-owner occupied, maybe even less than what was reported with Kathy's commentary. But yeah, I would say that those are probably the primary drivers for that.
Perfect. Yeah. And with the jobs report being released last week, and then the consumer price index report coming out this week, do you expect the rates to shift more, or what are you thinking for the near term?
Well, the jobs report came in about 30, if I remember correctly, about 30,000 light of what the expectation was. I think it came out 143. Expectation was 170. However, unemployment went from 4 to 4.1. So it went up by 10 basis points. Um, I'm going to reserve my commentary for where I think it's going to go until I see that piece, that CPI. But ultimately, let's just kind of take this and go big picture. And by big picture, I'm going to go 30 to 60 days max. I really rarely will ever try to forecast beyond that because there's just too many variables and moving parts. I think we're staying steady, man. I don't see anything that would lead me to believe that interest rates are on the downward. I don't necessarily think that we're going to see any increases significantly upward either. But that said, it's a good reminder for me to reiterate the point that investors, if you're not doing the math, and I'm talking to investors, obviously that's why we're here. If you're
Mhm.
not doing the math and you're psychologically hearing 7% or 7.5%, whatever it may be, and you've bought yourself mentally out of engaging in real estate, I think that's a real disservice. Okay. You
Absolutely.
need to be looking, the principal and interest payment is what's important, right? So take a $150,000 loan amount or whatever it is, and make sure you understand that the difference between 7 or 7.5 on the loan amount might only be $8 a month. Just do the math is the point that I'm making.
Yeah, that's all great. And do you mind touching on or explaining about how mortgage rates follow the 10-year treasury and bond investing?
So there's obviously a direct link. A lot of times when people want to predict where interest rates, long-term interest rates are going to go, that's the measure that they're going to be looking for. And while I don't disagree that it's an okay place to go, that, like I said a few minutes ago, there's so many other variables that are going to dictate where rates are going to go, up or down or east or west or what have you. I really would prefer investors to be looking at diversifying their portfolio, making sure they have backup plans, plan B, plan C, based on, differences in where the market can go with appreciation, where interest rates are going to go, vacancy, all of that stuff. I just fine, follow the 10-year treasury, but if you're really going to want to watch ticker tape and see where those interest rates are going to go, I feel like you've really got to do a lot more homework and due diligence to be anywhere near accurate. I mean, even with a small variant for error, you're going to have a lot of data crunching and topic reading that you're going to have to get into if you're going to be accurate in predicting where rates are going to go. I don't know if that answers your question, Stacey, but yeah, fine. Use the 10-year treasury. There's a lot more that goes into it.
Yeah, absolutely. Now, even with the drop being nominal in sense, the savings does add up, and any savings is still
Sure.
great for an investor. Do you mind touching on what that savings would look like for an investor per month with that even nominal decrease in rate, and then what that looks like over the lifetime of a loan?
Sure. First, let me just say I'm not trying to imply that interest rates are irrelevant. That's not my point. They're a lot less relevant than I think we give them credit for. So yes, of course, we want the best possible rate we can get. However, if it means the difference between engaging in activity of real estate and not, that's when I start to get a little bit more harsh with my criticism of people that just aren't doing the math. Okay, so the answer to your question is really largely about the loan size. If the loan amount is 250 and above, it's going to be a bigger spread. I'll give you an example. Let's take $100,000 loan size. Okay, the difference in monthly principal and interest payment between say 7.25 and 7.5, which is probably about the spread that we saw in any decrease from last week to this week.
Yep.
The difference in payment there is going to be, let's see if I can use this from memory, maybe $18 a month. So $18 a month over the course of, 12 months in a year. What is that? 200 and yeah, I can't do mental math. You guys can figure that out with your calculators or your iPhones. But about $18 a month, okay, is roughly what that is. And in terms of the life of the loan, my pushback there would be the chances of that mortgage being in place for 360 months is a fraction of a percentage point, especially for investors that are buying and selling and refinancing, 1031 exchanging, et cetera. The percentage of people that start with a 30-year fixed, I'm talking about investors, start with a 30-year fixed mortgage on day one and stroke 360 payments later to pay it to zero is damn near zero. So
Yes,
I would
absolutely.
focus on the interest. And, one of the things that we haven't really touched on yet is the interest savings. Okay, it's not
Mhm.
going to be dollar for dollar, but let's say that you were expecting a 7% interest rate and you're now at 7.5. Make sure that you include in your analysis and your math that extra interest that you're going to be able to deduct on your Schedule E at that higher interest rate.
Yeah. Yeah, and to your point about the not engaging, I'm the perfect example of that. I wanted rates to be perfect when I bought my first investment property, thinking I'm going to hold this loan for the full 30-year term. Literally cash out refied within the first year because of that appreciation. And that's the cost that people are losing is all of that equity that could be building just by not engaging and starting with those investment properties.
Yeah.
So definitely it's an opportunity cost when you don't get started. Do you mind talking about what rates are today and what borrowers should expect?
Yeah. And if I can, a little highlight on your comment, Stacey. I think that as a first investor or first time investor rather, I think that it's very common and even appropriate for them because this is a big purchase, right? This is
Mhm.
not just buying a car or something like that. This is a very, very big purchase. So I understand the hesitancy. I just think that they need to be informed in a real way that their decisions are measured, and that they have those extra security backup plans if they need to, and they have to be doing the math. But in terms of your next question, rates today. So I pulled these before we jumped on our call. Now, remember those LLPAs, you guys. If we're talking about a purchase transaction, I plugged in $150,000 purchase price with, say, 25% down, 760 or better credit, single family residence. You're probably posting somewhere around 7% today with 2 points in origination is roughly where you're going to be. That loan amount is 112,500, and at 7%, just so that you guys can hear it and the math, that principal and interest payment would be about $748 a month.
Nice. What advice do you have for investors who are waiting for the dip in rates to start investing?
I'm glad that you asked me this. I was recording last week for our YouTube and some of our social media, and it had occurred to me before coming up with that content or that topic. I think it might be time for a little tough love. Okay, I understand where investors, especially newer investors, mindset are. They're waiting for a break in the interest rates. But I got to tell you, man, if you're waiting for rates that were pandemic-ish, 3, 4, even 5%, you are going to miss out on a tremendous amount of opportunity in appreciation of property, appreciation of rents, depreciation in taxes. There's so much more than just that interest rate that you really need to be educating yourself about. So, not every property is going to pencil the same way. You need to be looking at the short term and the midterm and the long term, the different markets where property taxes are going to be higher or lower. All of those variables need to be considered. But if you're on the sidelines waiting for those interest rates, I think that it's a mistake. Look back historically, do a little bit of homework, and look back where 30-year fixed mortgage rates have posted historically over the last 20 or even 30 years. Go ahead and check that out. We're not too far now from where those historical averages have been, and investors have been investing all that time. So just educate yourselves.
Yeah, absolutely. Thank you so much for that advice. Shaylee, I've been so impressed with some of the different loan products that I've heard that you've offered. Even in my investing career, they're definitely unique and you have a lot of experience to add. Do you mind sharing some of the differences?
Yeah, thank you for saying that, Stacey. I think that Ridge Lending is uniquely qualified for investor type funding from a few different variables or a few different vantage points. Let's just say education is huge and it's customized. There is understanding certain guidelines as it relates to investment type loan products, but as it relates to you and your qualifications and then your goals is certainly it kind of raises the bar a little bit. So education, customized education is key. The diversity of loan product, as you said, we are not a one size fits all. We pride ourselves in having access to a huge diverse menu, I like to call it, of loan products. We've got the Fannie Freddies. We have short-term bridge loans, my favorite, first lien HELOC, which we talk a lot about here on the show. The ground up construction, so on and so forth. It goes on and on from there. You get the point, okay?
Yes.
And then licensed in 49 states is another one that I think a lot of investors appreciate because if you're doing it right, at least in the big picture, you want to be in not just one market, all your eggs in one basket. I made that mistake myself early on, and I learned those valuable lessons. So all three of those things I think are at the top of my list of real value adds for Ridge Lending and what we bring to the table.
Yeah, absolutely. And you've been a partner of ours adding value to the community for so long, which is awesome. Well, thank you
Yeah,
again for joining us today.
my pleasure. Thanks for having me, Stacey.
Thank you so much for joining us today at Real Wealth. If you would like to learn more about investing, find properties to invest in, have access to free webinars and tools, Caeli's information, or past educational classes, please visit us at realwealth.com. And don't forget, it's free to join.